Ladies and gentlemen, good day and welcome to the Q3FY22 earnings conference call of PB Fintech Limited, hosted by Morgan Stanley. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Subramanian Iyer from Morgan Stanley. Thank you, and over to you, sir.
Yeah, thank you. Hello, everyone. Welcome to the earnings conference call of PB Fintech Limited to discuss the Q3FY22 performance of PB Fintech and share industry and business updates. We have with us today from the senior management team, Mr. Yashish Dahiya, Chairman, Executive Director and Group CEO, Mr. Alok Bansal, Full-time Director and Group CFO, Mr. Sarbvir Singh, President, PolicyBazaar, Mr. Naveen Kukreja, CEO, PaisaBazaar. I would now like to hand over the call to Mr. Yashish Dahiya for his opening comments. Over to you, sir.
Thank you, Subbu. So this is Yashish. As Subbu said, I am the Group CEO for PB Fintech, and welcome to our first results call. And along with me, as Subbu said, I've got Alok, who's the Group CFO, Sarbvir, who heads PolicyBazaar, and Naveen, who runs PaisaBazaar. I want to start by saying we are not just a large insurance marketplace, but in an industry which is mostly a push industry. We are unique to have over 90% of our revenues from inbound consumers. In comparison, this number would be under 5% for most industry players. Consumers trust us and come to our platforms to get a wide choice of products. This is augmented by the best-in-class service levels that consumers feel confident about, both at the time of buying or afterwards. This consumer pull shift will continue to reduce our acquisition costs and improve operational productivity due to higher converting direct traffic. There are clear allied benefits for our partners in terms of higher level of consumer disclosure and thus data availability for sharper customer segmentation and better underwriting. We continue to be at the center of the digitization of insurance and credit processes, and our efforts using AI for video inspection, facial recognition, automated speech recognition, etc., provide a far superior experience to consumers and underwriters. I would also like to say we are now growing at scale. We are at an annual run rate of 8,000 crores of insurance premium and still growing at 60% year on year. At this rate, a simple calculation would say we could be adding 10,000 crores of insurance premium every 2 years, which very few have ever had the opportunity to do. So while we stay prudent, we cannot lose this opportunity and must make the necessary investments to build and constantly future-proof our business. We are continually working on improving customer experience, product offerings, and the claims experience. Some of our efforts on Doc Prime, India's first NDHM integrated digital health locker, the credit score program, the account aggregator, and the Visit Health investment are in the same direction. While we have invested behind new initiatives, the investments have been prudent, and our execution focus has brought the desired results, which I would like to highlight with a few examples. PB Partners became the #1 B2B2C platform in the country within just 6 months of launch, which was as recent as July 2021. In terms of buy versus build, this has proven a good execution on build, where we have built a market leader in under $10 million, actually $7 million to be precise, what would otherwise have cost more than $200 million to buy. PB MSME/corporate again is a grounds-up development from scratch and now has 1.1 million lives covered across corporates and MSMEs. While building core service capabilities necessary for that business and building direct engagement with employees of these MSMEs and corporates. PB's UAE business is now a close number 2 in a fast-growing market. And again, all of these have been done in a very prudent fashion without the kind of losses that one could get very worried about. While we will continue to invest in these 3, we anticipate to stay prudent and deliver exceptional results. Brand building stays key. However, we have now reached a stable state in terms of spend on brand. This year, PaisaBazaar was recovering from a zero-based brand spend, and thus that impacts any comparison with last year. Finally, we are very proud of our team, which is making all these initiatives possible in a seamless manner. We feel we have sufficient and committed talent to build as per our plans. We have very low churn as a management team, and our focus is on building the right cultural alignment, which we are very happy with, and the requisite entrepreneurial freedom to build, which keeps us a very exciting place to work. I'll now hand over to Alok to quickly cover some of the initial numbers before we open up for questions.
Thanks, Yashish. So our consolidated revenue for the first 3 quarters is 885 crores, and there is another 75 crore of deferred revenue, which is the revenue receivable over the next 12 months and for which we have already undertaken the cost. So together we have enabled revenue of about 950 crores. This does not include the future revenues due to renewal book, which at this point continue to be stable at 1.5x multiplier and would have a large impact on future profitability. I wish to clarify that the revenue for credit products is roughly 150 crore out of this, and the remainder is all either insurance or insurance related. Hence, our take rate in each segment have remained unchanged if you look at these numbers. While product mix changes are fairly common, in the last quarter, both health and life have grown at 73% and 50% respectively over last year same quarter, and this is multiple times industry growth rate. There is pressure on motor and two-wheeler insurance business across industry, and we are also seeing the same. On the other hand, the new business initiatives of corporate insurance and POSP business on a blended basis have a similar take rate as motor, and hence our overall take rate remains stable. I would also like to take this opportunity to explain that the fact health insurance continues to grow at a fast pace for us implies that our future revenue from renewal business will continue to grow, which is now at an ARR of 242 crore basis Jan 22 numbers and growing at roughly 40% year on year. Coming to PaisaBazaar, we have had a successful turnaround this year when we have come out of COVID impact, and now we are at credit disbursal ARR of INR 8,400 crores. We also have 26 million plus cumulative credit score users and have launched 3 new lending products in last 6 months, all of which are delivering as per expectations. To recapture quarterly performance in brief, our insurance premium grew by 68% year on year to 1796 crores. Our credit disbursals grew by 94% to INR 1926 crores. Total operating revenue for the company grew by 73% to INR 367 crores, and there is another 38 crore of deferred revenue on top of it. Existing marketplace business contribution margin, which is operating revenue minus direct people cost and minus acquisition marketing cost, was maintained at 40%. New business initiative revenue grew manifold to INR 50 crores from a very small base of 3 crores last year with an initial investment of INR 41 crores. Adjusted EBITDA without ESOP cost was at a loss of INR 92 crores, reflecting investment in new initiatives and brand advertising. ESOP charges were at 226 crores for the quarter. These are part of IPO prospectus and are part of fully diluted cap table calculations. These are also front-ended as 45.7% of the charge has to be borne in the first 12 months as per the India AS, and these will continue to come down over the next 5 years. Thanks very much. We would like to take on the questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Jain from Citigroup. Please go ahead. Aditya Jain from Citigroup, your line is unmuted. Please go ahead with your question.
Hello, am I audible?
Yes.
So the POSP build-up has been really rapid. If you could tell us a few things here. So along the lines of, so who is the customer here and what is he buying? So fundamentally, is there a market expansion happening? Do you see a very different customer from your main current customer set who is coming in from here? And is it right to think of this as a lower take rate but higher contribution margin business in the medium term? And the burn which you've mentioned here, about 40 crore, just the nature of this burn and how you would expect this to taper off over the next few years?
The customer over here is an insurance agent. We are essentially a platform. PB Partners is a platform where insurance agents come and they are able to, log in their policies and get paid for those policies. So it's a B2B2C business. The final customer is the customer of the agent. In terms of the take rate actually is pretty good, but I think the right way to look at it is the net burn, because what happens is that we get paid from insurance companies X and we give a fraction of that X back to the agent. So there is, there is some contribution from that, but we end up giving a large portion of what we get back to the agent. The third question that you had around the burn is essentially to build out the team, right? So we have to build out the team, we have to run marketing to attract agents, so we may run contests, things like that. So those things cost money, and that burn to some extent will remain because, last quarter was the first quarter where we kind of had full quarter of operations. And as we go forward, the scale will only grow, but the burn will also remain, and we'll start tapering after we reach additional scale.
Right. So my question was on the final customer. So essentially, I understand there's a B2B2C, but if we think of this as a new channel, so to speak, is it giving us access to, let's say, a tier 3, tier 4?
Customer. Aditya, it's a different customer. See, a customer who wanted to use the PolicyBazaar platform by coming on the website is a different customer to the customer who is usually using a POSP agent to buy a product. So it is an expansion of the number of customers that we reach out to. And so you're accurate in that. And a lot of this is from tier 2, tier 3 towns. So yes, it's also an expansion of the PolicyBazaar footprint in some manner in terms of distribution.
Correct, thank you. And just on the second part, you mentioned give a fraction to the agent. So the recognition that we do in the P&L, so that would be gross, is it? So the total amount which we get from the insurer, and then the amount paid to the agent will be in OPEX?
Correct, absolutely.
Okay, thank you.
Thank you. The next question is from the line of Sachin Dixit from JM Financial. Please go ahead.
Hi, congratulations on the results. Actually, a couple of questions. Quickly, I'll start on the piece of what my previous colleague was asking. Was like when you think of the cost of onboarding these POSP agents and the commission that you're passing on. So when we look at the P&L, where are those costs parked? Are those part of advertising promotion or other expenses? Where are those?
You are seeing them in the advertising and promotion right now.
Okay. Like, is it possible to break down advertising slightly in terms of like what is pure play marketing expense or like even including customer acquisition, what is this promotion, sales promotion expense sort of expense?
So Sachin, we have given some guidance in terms of how much the initiatives have costed us. So for the revenue of 50 CR in quarter 3, we have incurred a direct cost of about 91 CR. Hence you can see a negative 41 in the presentation. And most of it will go towards the marketing expense, which we bore for this. So, a way to look at it will be 50 crore revenue, but 91 crore cost. and a lot of it, 99% of that will be in marketing.
Understood. Okay, thanks for that. One more question on the deferred revenue piece. Can you elaborate on that? Like, how is it getting generated and what is the nature of it?
Absolutely. So suppose we are selling policies which are on a monthly pay basis. What would happen is the policy is initiated, but the customer has to pay over the next 12 months. So if I have initiated that policy, let us say in a particular month, I will only get paid 1/12 of the policy in terms of revenue, and the remaining 11/12 will come in future months. And that is how the revenue recognition is happening. However, while this would be correct for an insurance company, where the claims have to be paid out of those premiums, for a distribution company, where essentially all the work has already been concluded and all the costs have already been undertaken, my honest opinion is either the cost should also be accrued or the revenue should not be deferred. But it is okay, that's the reality. But as we grow, this wouldn't matter if we were not growing, but as we grow, this becomes a larger and larger number. So yes, that is definitely a gap which gets caused between MIS and we have to do absolutely no, like these are all payments which have been done through e-NASH or standard instructions. So it is just that, yeah, you get the story.
Understood. So it's basically almost 100% certain that you'll get this.
Yes, almost 100%, like, unless that person runs out of money or something, or decides to cancel the policy. Even to cancel the policy, he has to still pay for the first year.
Understood. Okay, thank you. I'll get back in the queue.
Thank you. The next question is from the line of Utsav Mitra from Alpha Wave Global. Please go ahead.
Hi. Thank you so much for the time. I would love some color on how the renewal book is continuing to build up and the visibility you have, and along with that, the impact on contribution margins you expect as the renewal book becomes a larger and larger percentage of the total book. Thank you.
So, for this year, and the best way to kind of do this is at an ARR level. So last quarter, our renewal revenue was about 55 crore rupees. And if you take a January month, it was 22 crore rupees. So, obviously January is unaudited. But these are the numbers, and that's why the ARR of 242 crore comes from there. This number is growing at approximately 40% year on year. Now, a bulk of this is actually health insurance renewals. Bulk of it, a vast majority of it. So you could pretty much, treat it as largely health insurance renewals. And specifically when you come to revenue, when you talk about renewal premium, that's a different issue, but revenue is important. In terms of margins, this business is more than 90% margin. We are, our board has made a clear instruction to us that we cannot give any guidance, etc. But we don't anticipate any change in the growth rates, and clearly this grows as your new business of previous years piles up.
Yeah, this is also a cumulative book.
So
every year it adds on to the earlier.
It's what I call day one revenue. I think the interesting part is, for the first time, PaisaBazaar has also started making similar revenue through their neo products that they are doing, and that is an interesting amount. Again, nothing about the future, but there is about 2 crores of what you would call day one revenue, which has started getting created by PaisaBazaar also. And that is not included in this ARR. This ARR is just the PolicyBazaar ARR.
Great. Thank you very much.
Thank you. The next question is from the line of Prashant Mittal from Ambit Capital. Please go ahead.
Hello, am I audible?
Yes.
First of all, congratulations on the result. My question pertains to the segmental revenue breakdown that you have given. Now, it seems that about 371 crore of revenue came from the other services on a 9-month basis for FY22. Would you be able to give some color on, what the take rate was like for the PaisaBazaar segment. Because if I just break down, this other services from standalone and the new initiative revenue that you have given, the take rate sort of comes a little high as compared to what's seen in the industry. So any color on that would be helpful.
So Prashant, out of this 300 odd crore or 317 crore that you mentioned, roughly 150 to 155 crore is coming from the credit business.
That's from 880. That's from your 950 crores, Alok. That is not from that. This is just one quarter.
Oh, okay. This is the quarter.
So let's just clarifying. I think Alok clarified in the beginning. Of the 950 crores of revenue plus deferred revenue. So revenue is 885. Only about 150 is coming from the credit side. The remaining, if I were to just do the math, just kind of be with me for that moment, 950 minus 150, about 800. All of that is either insurance or insurance related. So a bulk of it is insurance or insurance related. And you could, the numbers are not very different actually, because in terms of growth rate, Paisa's growth rate was a little higher in the earlier quarters. Q3, the growth rates have actually come quite close. So the numbers are not very different from that ratio. That should give you a good guidance in terms of what is the credit products take rate and what is the insurance product take rates, because we have declared the disbursals and
Prashant, in terms of take rate, PaisaBazaar has multiple lines of businesses. When we look at a product like unsecured lending, auto loans, home loans, we get what market pays to any DSA depending on the last mile legwork that we do. There are a lot of other services which are not at a percentage like credit card or credit advisory that we do. In those cases, it may be specific transaction-based revenue that we get. But on overall basis, for each vertical, our take rates will be broadly in line with the market take rates.
And all of these put together would be in that 150 to 155 crores for the first 3 months. Just clarifying. So, first 9 months. The first 9 months. Sorry, I said 3.
Understood. That's very helpful. Thank you.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Congratulations on very good set of numbers and a decent listing. I just wanted to understand, we've built a good business, which of an ARR of 8,100 crores in premium, 8,400 crores in the credit business in the last 8 years. I just wanted to understand at what level, at what ARR our expenditures would see a J curve in terms of profitability. Can it happen at $2 billion, $3 billion, $4 billion? At what level you believe that the flywheel will be self-sustained?
As I mentioned, I am not authorized by my board to give any forward-looking statement, but I do feel the need to satisfy the curiosity on this front. I think people will not have to wait very long, and so is all I would say. I don't think you'd have to wait very long for that.
Okay. And just wanted to understand if we just got the broker's license, and under the broker's license we'll be able to charge commissions on the life insurance renewal. So the premiums which were collected earlier, was a part of that, or we started getting under the broker's license now?
Every time when we change licenses, I just wanted to kind of give a bit of color on this because you are all very, it's important for you to have that. Every time you change licenses, what happens is all your contracts undergo a change. Because if I have a contract with an insurance company as a web aggregator, then now I will have to have a contract as a broker. And when these contracts undergo a change, there is a period of what you can call turbulence. Now, this has happened to us twice in our lifetime, once when we got the web aggregator license and then when we got the broker license. So there is a period of turbulence that happens. And so, yes, we have come through that period of turbulence is what I can say. So some of our revenue numbers and revenue recognition in the first quarter, second quarter could potentially have, but as time progresses, they'll start to settle down. You are absolutely right in the fact that as a broker, you can have renewal revenues That does not mean we will have renewal revenues. It just means legally it is possible for us to have that renewal revenue. I'll leave it there. I think as time passes, we will see more and more color around these.
Yeah, I just wanted to have a follow-up. I just wanted to understand the economics between a broker license and an aggregator license. So, if for the benefit of everybody, can you just explain the economics between the two?
I can give you the facts between the two. I don't know if they. So, a web aggregator cannot make life insurance renewal revenue. A broker can. A web aggregator can only sell online and in a remote manner. A broker can physically meet a customer. A broker can service claims. A web aggregator cannot service claims. A broker can do corporate business. A web aggregator cannot do corporate business. A broker can appoint POSP agents. Can appoint POSP. A web aggregator cannot. So if you notice, some of the lines of business which we have done, correlate with us getting a broker license. So they were initiated pretty much then, and most of the growth you see is post that.
So you basically see the renewal revenue share going up to, let's say, 40 to 50% in the next 3 to 4 years, from current 15 to 20% into insurance.
I cannot, as I said, my board has not authorized me to do something. I cannot do it.
Just one last question, just for the benefit of everyone. Can you please explain your offline store strategy?
Sure. So our offline strategy is very simple. All our demand is generated online. So every journey starts from coming to PolicyBazaar.com and entering your details. Once you enter your details, you have 3 or 4 choices. You can go and buy yourself. So as you know, in our motor and two-wheeler business, vast majority of transactions happen unassisted. People buy themselves. In our health and life businesses, we speak to people on phone. We speak to them through a video call. And now we are adding the capability to go and meet them at home. So our agents offer the opportunity to a customer saying that, sir or ma'am, if you would like us to visit you at home, we can either come ourselves depending on the city that they are in, or they can send a colleague who will go and meet them. So all journeys start online. They can be fulfilled in different ways, and offline is one of the ways in which we are fulfilling it. This is the main strategy that we have, and we've deployed about 300 agents on this already, and this is slowly becoming a bigger portion of our business. The other part of our offline business is the point of sales business, which Yashish just spoke about in depth. That is a totally separate business, which is a B2B2C business.
Also to clarify, our offline fulfillment at this stage would probably account for about 3 to 5% in that range, between maybe about 3%. About 3% of our total revenue would be coming from that. So just to give some guidance around how much of the growth is because of that, etc. My honest opinion, it's not happened yet at scale because it's so early in the process. Please appreciate we could not have done this before we got the broker license. We only started doing it. But whatever results we have had are very encouraging in terms of what's possible.
Got it. All the best. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Abhishek Saraf from Jefferies. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I just have 2 questions. So one on, sir, with regard to our online business, what our premiums on our platform have grown 68% YOY. Within that, if you can just let me know, means how much did the new business premium grew at? And as you mentioned that the means I believe that renewal has grown at 40%. So would this imply that new business premium has actually grown at much faster rate? Secondly, in our offline model between POSP and the other one in which is the online-offline combination, what would be the breakup of revenues between of the 50 crores that we booked this quarter? And lastly, on the corporate business, if you can help me understand what sort of businesses are we writing? Is it mainly life insurance or health insurance? And what would be the take rate differential on a product like-to-like product basis?
So I will, briefly answer and then hand over to Sarbvir for any details. The new business. Sorry, somebody is echoing. Okay, so the new business growth rate is 68%. It is on slide 3 of the presentation that we have made, and it also puts out how much of it is life insurance and health insurance. I just wanted to clarify, because this can be a big, dampener if it is mentioned that way. Our any health business done in the corporate side is not being declared in our health business at all, because otherwise I can show very high growth in health by just putting corporate there. That is all retail health business only that we are talking about, that is growing there, and the entire renewal book, etc. I think your question in terms of breakup of revenue, etc., I don't know if we have that level of detail in terms of how much of that 50 crores is from corporate and how much of it is from POSP. I don't know if we have that level of detail to share.
Okay, right now I think POSP is growing much faster. Corporate takes a little bit of time because it's mostly based on the team getting built, where POSP is more of configuration. So POSP is a larger chunk of that. And within corporate, we do have large corporates and MSMEs. Focus on both of these business lines. Large corporates are typically group medical sort of policies, and MSMEs can be a mix of multiple type of policies, including group health, but also professional liability, shop and service, lots and lots of stuff.
Sarbvir, you want to provide some color on this?
Yeah, so on the corporate side, as Alok was explaining, we do group health, group life, we do some group personal accident as well. For the MSMEs, we again do group health, group life, and we also do marine, fire, shopkeeper, small office, startup package, DNO, so various other kinds of lines as well. And as Alok again mentioned, we are building out our team. This is a team-driven business, and as the team expands, we will, cover more comprehensive lines of coverage.
But I just wanted to re-clarify, neither the health nor the life business is disclosed in the growth rates of our health and life. Those are purely retail.
And without POSP.
And without POSP. That does not include POSP also. The 68% is excluding POSP. We totally recognize that the POSP business and non-POSP business are different, and so we feel the need to declare those differently.
Yeah, thanks for that response. Very helpful. Thanks a lot. Yeah.
Thank you. The next question is from PaisaBazaar from DSP. Please go ahead.
Hi. Congrats on good set of numbers. Just couple of questions. First, on the revenue side, if you could just break the 367 crore revenue from operation into insurance, POSP, PaisaBazaar, and other business, that would just help. And also the same number for 3Q21 for reference.
Yeah, when we look at the quarter 3 numbers of 367, roughly 65 odd comes from credit, and everything else would be insurance or insurance-related revenues. This includes experiments or initiatives that we have started off, and the total revenue coming from all the initiatives is about 50 crores within this. So roughly 65 from credit, rest from insurance and insurance-related, which includes 50 of initiatives.
And initiatives is all insurance?
Yes.
So it's all insurance revenue?
Got it. And the same number for 3Q21, just for reference?
Yeah, so the same number would have been 885 total, out of it roughly 150 to 155 coming from credit, and rest coming from insurance and insurance-related services. And the total experiment or initiatives, out of that would be 71.
And the entire deferred revenue is insurance only?
And deferred revenue is over and above this. 75 crore extra deferred revenue.
See, the reason we mentioned is deferred revenue, it is because it impacts our profitability. Otherwise, we would be quite cool and not kind of mention deferred revenue again and again. But, it hurts to kind of know that your profitability is lower because cost is there, but the revenue is not there.
Understood. The second question was relating to the employee cost. So if you X out the ESOP cost, the underlying employee cost is still growing at 60% plus. If you take that as a percentage of the operating revenue, it's in around 46% or so. How should we think about that part of the cost component, or should we look at it in total ESOP plus non-ESOP? Just internally, how do you think about it, and any comments that you can provide on that front?
No, so you're right. This year we have invested behind these initiatives, and everything obviously required a little bit of team build in the initial years. We have also invested behind building a team from claim and service experience for the consumers. That's something which is very, very critical as we look at our long-term business strategy. We have also invested a little bit behind the whole offline strategy, as Shabir mentioned earlier. So there have been a little bit extra investment we have done this year, but we believe these investments in the current year are going to be very, very helpful when we look at how the business will pan out over the next 2, 3, 4 years.
And see, whenever you scale up anything quite rapidly, like reaching number one position in the market within 6 months, while other players have had 4, 5 years to be number 2, number 3, etc. Obviously, it does imply your accuracy in terms of getting every aspect of the team right on day one is obviously going to be lower. I'm not saying it is that we've done a bad job or anything, but you will see some settling out. I think one should see some settling out of these things also.
Yeah, typically, wherever, like in corporate business also, the day you hire, the person will not start to cover their cost on the day one. So typically, you have a little bit of time where the team starts to scale up, starts to come together, the platform starts to become more mature, and that's the investment we want to do in the business.
Understood. Just one final point relating to the cost part. So in your internal classification, there is a direct cost and then there is an indirect cost. So when you think about the A&P cost, is there any split that you do between direct and indirect? And if so, what's the logic for that?
Yeah. No. So see, for the existing businesses, the split is a very mature one, and you would see it very clearly. For the new businesses, there could be gaps in it. There could be. I'm not saying there are, but since they are just 2 quarters old, both the new businesses, if you look at corporate or POSP, they are 2-quarter-old businesses. So there is always a possibility that, some of the classifications are not very accurate. But I think as the quarters evolve, we should get more and more accurate classification. The rule is very simple. If the sale gets impacted by the existence of an individual, or if it's as the number of sales increase, if more individuals need to be added, then they are direct costs. And all of those go into direct costs. We've been clear about it from kind of the last 14 years, so that's not new accounting for us. And anything that does not get impacted by sales, or more people don't need to be hired just because your sales are expanding, is going into indirect costs. And so, and I do take your point, and I fully accept there will be some gaps there in the first 2 quarters, but obviously we will sort those out as the quarters roll on.
Perfect. Thanks and all the best. I'll come back. Thank you.
Thank you.
Thank you. The next question is from the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. So just one question. When I look at your ad spends and I try to knock off the new initiatives costs which you have incurred, the growth in ad spends is far higher than your revenue growth. So maybe if you can talk a bit about that. And secondly, just on contribution margins on the PaisaBazaar side, if you can spell out that. And lastly, on this monthly pay policies, which policies are these? Are these health, life insurance, motor? Because when your DRHP was disclosed, the renewal rates were quite low, isn't it? I think it was 30-35 for motor and health 70. So let's say if the persistency goes down in the year 2, what happens then in that case? Yeah, 3 questions.
No, so the deferred revenue has nothing to do with persistency.
So if he doesn't pay, then the cost is gone, right, sir? So if he doesn't pay, let's say...
If he doesn't pay, of course, but what I'm talking about is it is not about a new policy. Persistency is usually related to a new policy. And the renewal rates you are speaking about are related to a new policy. So both in motor and health, those are new policies, a next year policy being taken. This is an annual policy which has a mechanism for the customer to pay on a monthly basis.
Okay, got it. Very
so basically the customer has signed on to a credit card or something of that sort through which he will pay on a monthly basis rather than pay upfront. Which were the other two questions? One was the
contribution margin in PaisaBazaar and
now the acquisition cost. Alok, do you want to take that?
So in quarter 3, Prateek, if you look at our total acquisition cost, it's moved up, which is including about 75 plus crores coming from the initiatives. And, PaisaBazaar also is coming out of a COVID year. If you look at comparison of
last year was zero for PaisaBazaar.
Yeah. So because of that, the PaisaBazaar spend seems much higher, plus the initiative expense looks much higher. And we have done one specific brand experiment to see how it works for us. So that also gets added to the whole total here. So in a way, yes, there are 3-4 reasons, but
it's a triple whammy on that.
Yeah, but we have got to a stable stage now. If you ask me honestly, we have got to a stage where we see our brand spend to be quite stable, at least for the foreseeable future, and let's see how that pans out.
So what is that number, sir? I mean, I'm just trying to, just trying to appreciate or understand this advertisement cost between branding, marketing, and variable, right? Adjusting for all the new business initiatives of 75 crore which you talk about. Even if I adjust for that and then I see the growth seems to be far higher than your overall revenue. So just trying to understand what's a steady state number to look for.
So our brand spend usually is about 35 to 40% of the total existing business marketing spend. And initiatives obviously are very young, and we'll see how those pan out and how much we want to commit behind that as we see them built out over the next few quarters. But for the existing core businesses, roughly 1/3 to 40% will go towards the brand, and rest will be more of acquisition marketing.
Okay. And lastly, contribution margin on PaisaBazaar, sir, what would that be? Would you like to talk a bit about that?
Yeah, in terms of contribution margin, Naveen, you want to cover that or?
Yeah. Okay. So as for the 9 months in this year, our contribution margin would be around 30-31%. If you compare it versus last year, it's in early double digits, so it's improved from that.
And then when we're talking about PaisaBazaar, this is the credit business we're talking about. So credit business, when we got a chance to reboot post-COVID, we were able to relook at our direct cost much more generally and were able to optimize a lot more as we came back to the pre-COVID levels.
Okay. And lastly, on PolicyBazaar partners, PB partners, what kind of churn are you seeing when you onboard your partners over there? Because, today this is a negative contribution margin business, and obviously you are building that out. But if you were to draw a path, and it looks like it would be very fast because, you are of the view that very soon
It's too early to gauge that. Remember, we've just done this for 6, months. It's too early. We have roughly 20,000 partners, 40,000 registered partners who are waiting to get their approval through the regulator to become partners. So I think, we should be 40,000 soon. We have to still see.
Yeah, no specific comment at this stage in terms of how it will pan out from the churn perspective. I'm sure a lot of these partners, if they don't do any business at some point will get churned out, and that's a natural churn which will happen. But too early for us to actually comment on how that will play out.
And do these new initiatives, last question, delay your J vision which you talked about being very soon? Because that's what I was worried about, that, because if the business model is still not established on the new initiative side, whether it delays your J curve ambitions.
Not really. Typically, each business has its own maturity. When we are looking at the marketplace model of PaisaBazaar or PolicyBazaar, they are now decently established in terms of maturity, in terms of the cost structures, efficiencies, and we continue to work on it. So the existing business, we obviously have a large level of comfort in terms of how they are going to pan out over the next 2 years. Initiatives are very early stage, and they are going to be a bit of future growth drivers at some point. We are expanding the market. Earlier we used to do only retail, now we are able to talk to corporate customers. Earlier we used to only talk to customers who come to us, now we are able to reach out to customers through POSP agents as well. So this is expansion of the value chain across corporate, across a lot of other segments. And as these initiatives scale, we'll see at what point, what sort of traction we get on each of these. And we have been very prudent in these usually. I mean, we look at our unit economics, our scale and growth, and what does it mean in long term. See, remember, Prateek, it's been 14 years for us, and we are here for a marathon, not a sprint. So in 6 months, nothing will change in a substantial way, but in 5 years, all will add up, and it will look like a very different company.
Sure, Alok. Thanks, and all the best.
Thanks.
Thank you.
I don't think you can compare the POSP and the core business, and I think that comparison would be very unfair. The core business is very, very precious, and that's exactly why we are giving you all the classifications there and all the segregation of revenue, etc. there. I don't think it's the same quality. Nobody can build our core business in 6 months. If it was that easy, but the POSP can be built by 6 months by anybody, not just us. I think we are, lucky to have the opportunity. But so yes, I do think there is a big distinction between the two. But for us, it makes sense to do it from a scale perspective, supplier partnerships perspective. Insurance is a multi-channel model at the end of it. Yes, you have to be everywhere.
Surely. Thanks.
Thank you. The next question is from the line of TCM Sundaram from Q3FY22 Ventures. Please go ahead.
Congratulations, Yashish and Alok, for fantastic results. Ravin and Naveen too. I had one question on the ESOP. There is a ESOP slide which is there. So that is the year 1 hit or year 2 hit, because it says ESOP 2021.
So TCM, typically for any new scheme, there is a waterfall sort of an impact because of India AS. Our current October 21 scheme is a very simple scheme where it is a 5-year into 20% vesting. In such a scenario, the description that we have given, that the first year charges that PNL has to take over 12 months is about 45.7%. Now that is divided by quarter. So 2 quarters in the current fiscal year and 2 quarters in the next fiscal year will have that impact. After that, it comes down to 25.7%. It continues to come down almost like half every year. But because it is spread over 2 fiscal years, broadly for fiscal 22 and fiscal 23 numbers are not going to be very, very different. After that, you start to see drops drastically. But this is because of the way India AS asks you to look at the ESOP charges, where the first year charge you have to take 100%, second year you have to take 50%, third year you have to take 1/3, fourth year 1/4, like that. So there is a waterfall of ESOP charges which come. But broadly speaking, they halve every year. But I like to add one more point. See, this is something which was there in the IPO prospectus, and this is already baked in the fully diluted calculations. So there is no investor impact and there is no cash impact coming from the ESOP charge. So we have to be very mindful of both.
Absolutely. Thank you.
Welcome.
And excellent job by the team.
Thank you.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening, and thank you for taking my question. First, just sort of dwelling a little bit more on the new initiatives and the POSP model. So I think you said you added 40,000 agents. Is that number correct?
Yes. Yeah, all I would say is, look, I'm not the biggest fan of POSP. It's a business we're doing. I think today we've had about 50% of questions on POSP. We're not a POSP business. We're just doing it because it's happening, right? It's happening in the market, and we just entered and become the market leader. But that's not a major part of our business. It's just it's just there. Yes.
Right.
Just 2 things. See, if you look at what the market dynamics are looking like right now, there are players out there who would be valued at whatever number. I don't know what number, but maybe 100 million, 200 million, 500 million. We were able to get to a scale which puts us at number one by spending a fraction of that amount, between $7 to $8 million, in only a 6 months time frame. That tells you something about execution. That tells you something about our thinking, that we are more built by nature, and we are not going to go out there and put money behind something where we believe it's not going to be as cost effective. That's all.
So yeah, that was actually going to be my next question. So you spent about $7 to $8 million for adding 40,000 agents, and is any of that capitalized or is it all expensed out?
All expensed.
And how should one think about this business in terms of what can be the agent productivity? And so per agent, what sort of revenue numbers?
I think there's a little bit of confusion here. These are not our agents. These are POSP agents. They are not on payrolls. They have their own customers. They use our tech platform because we have got deep integration with the insurance companies. We have a very, very efficient platform to buy. We have a brand which sort of builds trust for these POSP people when they go out to meet their customers. So the customer has not come to PolicyBazaar. The POSP agent has ever used our platform to reach out to their customers to make life easy for himself and also give options to the customers.
So he also obviously would be getting some, so I understand that, and because he's affiliated with you, and you would probably be able to negotiate better terms from insurance companies on commissions, and he probably would be getting a better payout also. Is that the case? Can you explain that a little bit? And on an average, what sort of premium flow through can we expect? What sort of hence revenue and then pass through to him should we expect, right? And you mentioned
we don't have that level of details yet. We, of course, at a business level, we would have it, but not at a stage where these can be, so mature that we can put them on calls like this one. But all I would like to share with you is a typical agent in the country today, a typical seller of insurance sells 1.5 policies a month.
Okay.
This guy, imagine what kind of support he must be getting from the large organizations that he works with. He has to follow up, he has to go to the branch, he has to get these policies issued. It's a lot of paperwork, it's a lot of all that stuff. PolicyBazaar is a ready-to-use platform where he can come online on his app, which is the PB Partners app, register himself, get licensed from the IRDA as a POS agent, and once he gets that, he can sell products across the market, not for one insurance company. Imagine for 1.5 policies a month, how many insurance companies are going to tie up with? Even if your uncle and aunt could tie up with multiple people, right? You get one single link, you tie up across the board, you sell whichever product you wish, which is the bulk of what you are selling, and you get paid for it, which is what PolicyBazaar pays you. It pays you on time. It is basically that. It is convenience. This guy is coming here for convenience. And of course, some business gets added because there may be some people who may not do this business at all. Because, suppose I had one uncle who was going to buy one policy from me, I may not get into the insurance business. But if something like this is available to me, I might just do that. And because I have this, I might also sell to his wife and his sister and somebody else. So to some extent, it does expand the market. Specifically, these are very small agents. They are, and we don't have any fixed cost of theirs. They are all on variable cost basis. At some point for the better performing guys, we may start to have some structures and all that stuff. But more than that, this business does not require more attention than that at this stage. As the quarters dwell and as this business scales up, we will give more clarity on it and we'll have more data on it here.
Right. And just one thing, is the agent sort of making
something else?
Is the agent sort of getting a higher take rate through the PB Partners app, or if he would do it independently? I would still assume that it's still probably better to be under the PB Partners umbrella because the convenience it gets.
Oh, look, the agent is not really loyal. No, he can go to anybody. He's not really loyal. But what I have heard anecdotally, and look, that's why I don't want to get into it, because a lot of it is anecdotal, is the guy will probably take a few percentage points less from PB partners because PolicyBazaar is a more established organization. He can trust the payout more. He has a little more trust in the brand, etc., etc. I'm sure other people have different arguments. The fact that we've got to number one status in some time kind of proves what we've been saying. We've been saying this before we could start, that we will get to number one status very quickly. And I think how we hopefully scale in the future will probably prove that part a little more.
Right. Thank you and all the best.
Of course, welcome. And sorry if I was getting slightly hampered.
No. Not at all. Not at all, sir. Yeah, all well taken. Thanks.
Thank you. The next question is from the line of Saurabh Dhole from Trivantage Capital. Please go ahead.
Yes, sir. Good evening. I have two questions. So the first one is I just want to understand PB's offerings a little better. So is it like more relevant to the smaller players versus the larger ones? And in that context, if you could tell us what is the share of, say, the top 5 general insurance players in your total general insurance premium pie? So that's question number one. And second question is on 2 data points. If I could get the ESOP cost for Q2FY22 and the insurance premium for the same quarter.
So we won't have what is the share of top 5, etc. I don't think we have that on the on the slide, but we have a decent proportion of players. So in the health space, all the top players are working with us, and across the board, a lot of players work with us, and these things keep happening. Right? Sometimes some players will not work, and they work in different areas. So these few events will keep happening, but more and more we have bulk of the players with us.
Yeah, sort of what also happens is, depending on the vertical, it's a customer who is choosing the insurance provider and the policy that customer wants. So for health and life, typically they have a preference for more established brands. Sometimes they will go for product features. For general insurance, they may go for a little bit more of price sensitivity, and the volume may get spread over much larger number of companies. But if a company comes up with a better product, if a company looks at a specific customer segment more closely, or if a company comes up with, a very easy way of buying in terms of some ease of process, the volume starts to go to that company automatically, and it keeps on shifting. So there's no way for us to even say that, okay, this is what has happened in last year and this is what's going to happen in this year. With the partner perspective, as partners evolve, this volume keeps on shifting a bit. Altogether, it depends on the management team of the partners, where how much they have the focus on building direct and online channel, and how much they have the focus of working on looking at a pull customer and what that pull customer means. Little different thinking is needed, and we have seen that volume shift multiple times in past 14 years.
Okay. I understand that, I guess, on the general insurance side, that could be true, but is it true on the life insurance side also? Is it as volatile?
So, yes, very, very volatile. Yeah, we don't want to go into specifics, but if you look at it over a 1-year basis, you see multiple cycles when, if there are price changes or product changes, volume shifts from one insurance company to the other, and those can be multiple tens of percentage point shifts. Yeah.
And I just want to add one thing that I sort of heard in your question. It's not large versus small. We are very representative of the industry. The large players are large on our platform, and relatively, other smaller players are small. So it's not that, with the kind of scale we have, we very much represent the market. And you would have seen now, we pretty much cover all the insurers, right? And with LIC coming on board, I think that kind of, puts, I think, an end to that speculation at least, that everybody, wants to work with PolicyBazaar.
Okay, and if I could have those 2 data points, sir. One is the ESOP cost and the second is the insurance premium for Q2.
I think the ESOP cost would have been much lower than what it was in Q3, maybe around 130-140 crores. And premium, I'll have to check a little bit for Q2 specifically.
We've given the total. We had declared Q1. I don't have declared Q3 also, so I think we should be able to find it and kind of inform you specifically.
Okay, sir. Okay. Thank you so much.
Thank you. The next question is from the line of Dipanjan Ghosh from Kotak. Please go ahead.
Good evening, sir. Just one question from my side. if I look into your life insurance business, can you shed some color on, whether the small book of non-linked traditional savings is that picking up, and if you see the traction in that segment or the mix has broadly remained similar between term and linked out there?
Yeah. So just to give you a sense, our life insurance business is almost evenly split between term and savings products. In savings products, we sell ULIPs. We sell a particular capital guarantee solution which involves a ULIP and a non-par, so which is non-linked. And that is one of the mainstays of our savings business. And we also sell non-guaranteed plans which are very popular these days.
Okay, but has there been any shift in the mix? I mean, do you see any significant shift post the incorporation of the offline channel, or do you expect the mix to change incrementally?
No, I think we are very focused on the term business, so term continues to be about half our overall book. We are growing our savings products also quite smartly, but we see growth in both segments, right?
Sure. Thank you. That's all from my side. All the best.
Thank you. The next question is from the line of Jan Karote from Credit Suisse. Please go ahead.
Thank you for the opportunity and congratulations on the good set of numbers, sir. So I wanted to understand a bit more on the mix following on the previous question. If you could tell us a little bit about life versus non-life in the premiums, and also on the non-life, if you could tell us what have been the key drivers and what do you see to be the key drivers in the next 2 to 3 years product-wise?
So the way we look at our business, Jayant, is less of life versus non-life. We look at life, health, and GI. Because, non-life includes health and that confuses a lot of things. Our focus and our, heart lies in life and health. So life and health both have done very, very well. That's good. In Q3 grew by about 73% and 50% respectively, which is about 3 to 4x of industry growth rates. General insurance, which is mostly motor and two-wheeler, has seen a tough time as an industry in last, I would say 1.5 years of PTV. And we also seeing the same reflect in our book. Team is trying to do a lot of stuff, but since there's an asset-backed insurance, there's only so much industry can do. For term and health, we all understand the base is very small, the opportunity is very big. With under-penetration of the whole sector around health and life, there's a huge, huge amount of scope to grow. But if we look at our total premiums, I would think our health and life on the existing business would be more like 3/4 or a little higher.
Around 75.
See, if you look at these numbers, 73% growth in life and 50% growth in health. If you were to ask me a soft answer, first of all, I wish they were the other way around. I wish health was 73% and life was 50%. I genuinely believe we have the potential of being that than this, but that is a soft answer, right? But both are growing very well. And as Alok said, we look at the business in this manner: protection and non-protection. I know that's slightly different from how the industry looks at it, but now increasingly the industry is coming to our view, because if you look at the health business, yes, it is part of GI, but a bulk of it is being done by the by the people who are kind of more focused on the health area. So that need for focus is sort of kind of becoming a bit clear there. And yes, we've also recently started seeing some GI companies do very well on the platform for health. So that's heartening for us. And a few of them started to hit some good numbers, and we are very, very pleased by that. But all I'm trying to say is we see it this way. And so as Alok said, the motor business has been challenged. The entire industry has been challenged on that front, not on the claim side, but on the premium side. But health and life, we have outgrown the industry by between 3 to 4x.
In fact, do you look at it from a market share perspective? I mean, I know too early right now, nascent, but how do you look at it from overall digital penetration and our market share in that space in health and life?
We don't get into market share, etc. We are doing our bit, and we are, I think if you look at the last few years in term, there's been a lot of market share gravitation towards us, but
Yeah.
we don't want to get into those arguments of is our market share growing low. Obviously, if we are growing at 73 and 50 and the industry is growing at 21 and 13, then obviously we must be,
Yeah. Just to add on that, just to summarize, you're saying 3/4 is coming from these two and the tilt is right now more live, but and then medium term you see health becoming the centerpiece or the larger pie between the two.
Let's not get into guidances, but I think you get the drift of what I'm trying to say.
Yeah, sorry, and just one last question. What do you think about manufacturing? I mean, do you see yourself slightly ahead in the future, but do you think at some point you'll have to look at that question?
No answer is where I would leave it here.
Okay, sir. Thank you and best of luck.
Thank you.
Thank you. We would request participants to limit your question to 2 at a time. The next question is from the line of Preeti RS from UTI. Please go ahead.
Hi, good evening, team. Thanks. Yashish, this question on the LIC partnership, right? So I want to understand the importance of this to PolicyBazaar and the benefit that it could come in terms of growth, like pre-LIC partnership and post. So obviously we didn't have access to almost 40% of the life insurance market, but it's a whole different clientele there, which are used to a different kind of selling experience. So how do you expect this to benefit us, and what could be the timeline? And will this actually tilt our mix towards life going forward?
So Sarbvir will answer this question because he's been spearheading that relationship.
Yeah, so I think we've just started. As you know, right, LIC is a colossus and one of the leading brands in the world, not just in India. The best way to answer this question is that we are going to go step by step. They have an agency model. It's very widespread. It's very well spread out and everything. Our goal is going to be complementary. We will start by offering products that we think make sense, and probably we'll start from the fixed return plans as well as the ULIPs, and then slowly we'll build. As you know, we don't do participating plans right now, so that is a large portion of their business. So I don't think that for both of us, we will be very large portions of each other's businesses in the near future. But I think it's an interesting, product line for us because it's a very popular and customers want these brands, and we'll build this business out. So I think that's where we are today, and we'll see how it goes.
I just want to reconfirm, you mentioned ULIP, but historically LIC has not been, not been present in ULIP in a big way. So is that something that you would expect to happen on your platform?
Yes, they are not present in the sense that, because the other book is very large, but they are very, very keen to build their, they have a systematic investment and insurance plan called SEEP. They are very, they advertise that a lot, and that's something that I feel is a natural fit with our business.
Understood. My second question is on this, on the indirect marketing cost. So I think this is very important to understand this whole J-curve phenomenon to happen. Yashish, I think during the road shows, you mentioned that it's around 150 crore, which was the case in FY21. This is the indirect marketing cost. So how do you see this panning out over the next 2 to 3 years, split between the existing business and new initiatives? And this is also in the context of, the heating up competition that we see in be it PhonePe and other platforms who want to go for this, web aggregator sort of business model.
Yeah. No, I think we have this year spent what was required, and from here I genuinely do not, expect. I think we've kind of peaked out. From here it may, inflation based growth might be there, but we've kind of peaked out in terms of how much we need to spend in order to get effective, because we already have a brand and we already have a certain, service standard. We are able to manage with this spend, but yes, it has been higher, and of course that fact gets materially, at least visually impacted by two pieces. One is, as we said, optically, a lot of the new initiative payouts are happening through this area. And secondly, PaisaBazaar has come from a zero base. Please appreciate when PaisaBazaar when COVID happened, the first thing we did, obviously, with PaisaBazaar is you cut the entire media spend because you don't want more inquiries, because at that time there was people looking for loans, but the supply side was constrained. And so, of course, last year that spend wasn't there, while this year the spend is there because this year the suppliers are fully back. And that automatically means you're comparing with a zero base. So whatever happens gets added on, and that kind of reflects poorly on the results. In terms of profitability question, and I think it's a very fair question and one we are very keen to put behind us in a short time frame, and very confident of that. And what gives me confidence there is I'll share a few data points with you, which might give you also confidence. First of all, our renewal revenue, as I said, is at a run rate of 242 crores right now. Just to put in perspective, about 4 years ago, this would have been maybe 50 crores, 60 crores. Yeah. So it's, and I'm constrained from speaking about the future, but renewal is the most stable part of our business. Even if business does not grow, renewal comes with a 1 year backlog, if you would. So today the renewal benefits we're getting is because of our last year's efforts. And so all the growth you are seeing in new business premium, this 68% growth you are seeing is going to reflect in next year's renewal automatically. That is not really forward-looking statement. That is an obvious one. That has to reflect. It cannot not reflect. So, and in fact, if you think about it, last year we did not grow our new business as much. It was 3% growth just before IPO. We had 3% new business growth in the previous year. So our renewal, this 242 crores is off the back of that. But that's slightly unfair explanation because health actually did grow quite okay. So that's an unfair explanation. I take that back. I was just kind of thinking things through, and health has grown well this year as well. So I think if health has grown 50%, I don't see why that will not be reflective in the renewal book next year, and et cetera, et cetera. And of course, the future will depend on how we grow next year. So very confident that the renewal book grows to a scale where those margins totally dwarf all other spends. Very, very confident of that. And I think that is exactly how we will come into profitability. The second data point I want to leave with you, in our current run rate is 1.1 crore rupees of insurance premium per sales employee. This exact same number in 2019 was 46 lakh rupees. Now, that is giving you some trend in terms of operational efficiency. If you look out into the future, what is going to be one of our biggest costs is those operating costs. So if we start driving efficiency on that front, according to me, if you take a really 3-4 year, 5-year view out, the brand cost actually starts to get dwarfed in front of the operating revenues, renewal revenues, and some of the operating costs. They become much bigger as the operating cost becomes much bigger than the brand cost if you do that math, and that one coming down. So I don't think brand cost will stop us from hitting profitability for very long. And as I said, I think we have peaked out. And I've individually checked with both the businesses, and both have said, yes, this is about it. We are, we should not be requiring more than this.
Yes, thanks for that, Ashish. So if I can add one last question, we did receive the business updates for the last 3 quarters, but there was a bit of seasonality because there is quite a bit of variation in terms of quarterly run rate that we saw for the 3 quarters of FY22. So could you explain, is there seasonality in the business, or was there anything specific to the business in the last 3 quarters?
There is some seasonality in the industry. For us, it's not as much. From consumer perspective, there is a higher interest at the end of the fiscal year usually. But in our case, it's much more muted compared to the industry. Remember last 2 years have been very tough from the COVID perspective, when movement from work from home, work from office, all that stuff happening. So, it's very tough to clearly figure out a trend because of the COVID impact. This is a year where we already had 2 waves. The April, May, June period was a very, very tough period. We also went through the whole IPO process during this. So, lots and lots of divergence happening in the same fiscal. But there is no specific trend towards us being very, very seasonal. End of the year, typically, yes, there is a little bit higher consumer interest, which automatically means that there will be little higher conversion of the interest which comes to the platform. But industry is at a very, very different level of seasonality. We don't see that in a very big way.
Noted. Thanks for answering all these questions. Alok, I just have one request. In future presentations, if you could provide better disclosures on segment-wise. We have now 3 segments: policy, PaisaBazaar, and the new initiatives. I think that would help us, given this is a new business model, one of its kind for us.
Definitely, Preeti, this is noted, and we'll see what best we can do.
Yeah, thank you.
Thank you. The next question is from the line of Arjun Vikas from AlphaWave Global. Please go ahead.
Hi, thank you so much for the opportunity. Alok, yesterday I was going through the presentation, right? So if you look at 9 months FY21 and 9 months FY22 on the existing business contribution margin, which I believe includes both Paisa as well as the core PolicyBazaar business, right? So that seems to be at 36%. I heard in the call before that I think Paisa has improved on the contribution margin side, right? So just wanted to check whether, does that mean the contribution margins for the core business have been lower this year? So that was one. And if they have been, then on what accounts? And secondly, as you think about more offline and retail strategy, especially on the B2C side, with regards to home visits, etc., does that change our economics? Because, we have traditionally been away from this, and, it's kind of, the sales productivity of a guy sitting and making calls would probably be higher than the one outside, right, and trying to convert customers. So could you share some light on that?
Sure. So second part of the question, I think Sarabir will answer. On the first part, we explained that on a 950 CR revenue base, SI is about 150 CR, broadly. Right? So you're talking about something which is about 15, 16, 17% of the revenue. It can't have a material impact on take rates is where I would leave it. At the contribution margin. At the contribution margin, sorry, this is not take rate, contribution margin. It can't have a material impact. 15% of volume can't have a material impact on take rate, on contribution margin. Sarbir, do you want to cover the cost of as things move?
Absolutely. So Arjun, when a person visits somebody at home, first of all, as I explained, it is not a carpet bombing system where person is going to somebody's house whether or not the person wants them. This is by invitation and by appointment. So the conversion on the appointment is extremely high. So just any number that you can think of, it will be higher than that. The second point is that when a person goes home, there is a tendency to have a higher ticket size in products that is possible. In some cases, it's whatever is possible. So when you look at the overall economics, there is actually the economics of the agent improve because this is incremental to their conversion that they would have had earlier. The marketing cost remains exactly the same. The agent is paid the same. Incentive is exactly as it were if they were to convert sitting in their call center. The only difference I would say, the only caveat to my point is that there is, where we hire new agents, there is a little bit of a, learning curve which happens. But that, as you know, for any new agent, that learning curve does happen. So yes, there is a little bit of impact because of the learning curve. But other than that, the agents who are doing both calling and going home, their productivity is significantly higher than agents who are only calling. Which is what I think Yashish was saying, that this gives us the confidence that expanding this model is going to be economically accretive versus causing any other issues. And just one last point I want to explain, because I think a lot of people get confused because of the offline agent productivity versus online agent productivity. See, the industry is a push industry. So the productivity levels that exist in that segment are very low compared to both PolicyBazaar online productivity and of course then PolicyBazaar online plus offline productivity. So our productivity levels are frankly off the charts when you compare with industry averages.
Just to give you some data point there, so that we can all leave with some data there and don't kind of totally hold me to it, but it's broadly in the same direction. The industry is typically getting about 50,000 rupees to 1 lakh rupees of productivity per agent. Per month. Our person who's sitting in the call center is at roughly about 10 lakh rupees per month of productivity. And our person who is going into the physical space along with calling is at about 20 lakh rupees of productivity. Now the challenge is, as Sarbvir pointed out, the number, because these are two different channels, and the fact is you're putting in new capacity. So let me put it this way. 3 months in an offline, our kind of offline agent is actually more productive than 3 months in our kind of call center agent. But there are more of 1 and 2 and number of agents coming in. So you are going to see some challenge of that sort as we grow it. So you will see maybe a few months of that happening, and that's it.
Got it. Okay. That's it from my side. Thank you.
Thank you. The next question is from the line of Shubhanshu Mishra from Systematic. Please go ahead.
Thanks. My questions have been answered.
Thank you. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So firstly, what are the drivers of improvement in our agent advisor productivity? We have seen almost 40% improvement on a 9-month basis. So what are the drivers for that, and how do we see this number going forward? That is first question, sir.
We cannot speak about the future, but typically there are 3-4 things that happen. As we were talking about the physical thing where there is almost zero vintage right now. So as vintage builds in, a higher and higher proportion of your staff tends to be the vintage staff. And vintage staff typically does almost 3x more business than non-vintage staff. Vintage defined as, let's say, people with experience more than 6 months doing that particular task. And so as time progresses, you build up vintage. The second thing is, of course, our direct part of our traffic is increasing every year. And the direct converts at a much higher level. For those of you who've seen the movie Inception, once the guy gets it in his mind that he has to do something, he does it. If his father tells him to do it, he doesn't do it. I tell my children to do stuff all the time, they don't do it. But if they get it, they'll do it. The same thing, when the customer gets it in his mind that today morning I want to buy insurance and comes to PolicyBazaar that way, his conversion rate is far higher than us approaching him through Facebook or something that why don't you think about buying insurance, right? So that is the second element that clearly helps. And these are just things that will happen. The third element is, of course, we are investing in technology. All our technology and product people are working every day. Every review we have A/B tests, hundreds of them going on at any given time, and hopefully some of them are delivering value. So that also keeps improving every year. I remember Naveen mentioning that he interacted with the PolicyBazaar journey after a few years, and he found it to be very different from what it was a few years ago. So I think those changes also keep happening. I don't know, Sarbvir, you want to add any others?
Yes, you covered most of them. I want to just cover 2 points. One is that with increasing scale, it allows us to have differentiated products. So we now work with our insurance partners to develop products which make sense given the PolicyBazaar customer. So that helps in conversion. And the second thing is that we are also now looking at every business in segments. So our health business is looked at in 3 segments, same for terms, same for savings. So this segmentation breeds expertise. So our agents with their increasing vintage and expertise are able to convert better. So those are, I would say, 2 additional factors which have helped in the productivity.
Yeah, if somebody becomes an expert at handling people who are between 60 to 70 who've just retired, which becomes less possible if you don't have skill.
Sure. Just a follow-up on this. How is the trend in terms of customers who are able to complete the journey on their own complete? Is that percentage changing over years?
Yeah, it moves. So again, I think you have to separate the businesses. In our motor and two-wheeler businesses, vast majority of people buy unassisted, and that number keeps creeping up every year. In our health and life businesses, that number is relatively small, but it keeps increasing every year. And when COVID is there, then it tends to go up more. when COVID subsides, it kind of flattens out. But it keeps increasing slowly but surely every year.
And later days, another aspect you can't, for tough products or complicated products like health and life, the transition actually is, first of all, the talk time per transaction reduces. Because, a customer will need less and less assistance over quarters, and at some point, some of them will start becoming comfortable buying without assistance. But it's a journey, and over the last 2-3 years, as Yashish was mentioning, in terms of the whole effort that we put on the tech and product side, the effort required to close the transactions come down quite substantially, and that's what is driving the productivity per advisor. And slowly some of the customers will start to become comfortable buying a simpler version of those products as products also evolve, and we'll see some unassisted numbers creeping up in life and health as well.
And so secondly, on the health insurance side, how the take rate moves with the life of the policy. For example, how the take rate changes with the year of the policy. What is the take rate probably in the first year? How it changes to second year, third year, fourth year? Is it remains same? It remains same across the life of the policy, or it changes over the life of the policy?
So regulatorily, the take rate for health insurance is a flat take rate. You get the same amount in the first year, same amount in every renewal year, regulatorily. But in the first year, you do have rewards and remuneration, which make the first year payout slightly higher. So a rule of thumb that you can use is that the second year commission rate or payout rate, take rate, would be roughly 2/3 of the first year take rate. Also, churn keeps reducing every year. So the first year churn is the highest, second year is much lower, third year is extremely low, and by the fourth year, almost nobody churns.
And this 2/3 will remain constant across the life of the policy?
Third largely stays constant, yes.
Understood. And then lastly, if you can share the employee expense breakup in terms of direct employee expense and or the employee expense before contribution margin and employee expense after contribution margin.
Yeah, so when we look at our total employee cost, roughly 70% will be towards direct cost. We obviously have this operations team for sales support and for service support to the customers, and that will be roughly 70% of the employee cost.
See, there is a presentation along with the business thing, but in the presentation, what you would clearly be able to see is the contribution line, and the contribution line is after all the direct costs, as we understand them, have been taken care of. So that should help you kind of get to some number, with some simultaneous equations that I'm sure you will do.
Sure. It would be great if you can split out direct cost in the present, or at least one element of advertisement or employee direct cost in the presentation. That will help us.
Sure. Noted. Yeah.
Thank you, sir. That's it from my side. Thank you.
Okay.
Thank you. The next question is from the line of Saurabh Savla from Multi-Act Equity. Please go ahead.
Hello.
Hi.
Hi. Am I audible?
Absolutely, Saurabh.
Yeah. So my question was, with respect to your life insurance business, the renewal part. So how do we get paid for the renewal business right now? I mean, is that compensated us through the outsource service revenue line item which we have? And, will it change after we get this broker license?
Do you want to take that? My view is one shouldn't get into too much of the lines and all that stuff.
But life insurance right now in renewals is a very, very small component right now. At some point it may change. It's increasing a bit, but yeah.
No, I think it's best to, I think you should look at our revenue overall, and I think that's a very fair way of looking at, how we are compensated and, how things work.
Okay. So just a follow-up on that, I mean, around 40 to 45% of your premiums are contributed by the renewal premiums. So are we, compensated on that entire renewal premiums, or is it that on some portion we do not earn revenues till now because we were an online aggregator?
The part that we get commissions on or some payout on is mentioned here. The rest is not mentioned. So if there's parts that we do not get compensated on at all, or the compensation is crazily low, then those would not be mentioned there.
Okay. And again, one technical question. In the renewal segment, is it only the health in the general insurance or even the life?
See, from a practical perspective, from an analysis perspective, you can assume that the renewal revenue I've spoken about, which is at a run rate of 242 crores, a bulk of it, vast majority of it, would be health. So I think that should give you the answer in terms of, how to look at growth of the renewal book, etc. Remaining parts are there, but they are very small.
Understood. Yeah. Thank you. That's it from my side.
Thank you. Ladies and gentlemen, due to time constraints, it was the last question for today. I now hand the conference over to Mr. Subramanian Iyer for closing comments.
Thanks for on behalf of Morgan Stanley, I thank the management of PB Fintech for the detailed insights and their time. Thanks everyone for attending.
Thank you very much.
Thanks, Subbu. Thanks everyone for attending the call.
Thank you. Thank you.
Thank you. On behalf of Morgan Stanley, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.